All right, so the title of this paper is Analyst Following, Board Classification, and Managerial Entrenchment. There are three co-authors. I'm the first co-author, Ponsit Jirapon from Pennsylvania State University, School of Graduate Professional Studies. And I also have two colleagues on this paper, Pandit Jintrakan from Mahidol University in Bangkok, Thailand, and also Yang Sung Kim from Northern Kentucky University. All right, let me give a little introduction. If you look at the literature in accounting and finance, you see that there are many studies that have investigated the determinants of analyst coverage or analyst following. So the question is, each company is followed by a certain number of analysts. The question is, what determines the number of analysts for each company, right? So if you look in the literature, there have been studies going back to the 80s, and there are some studies that just came out in 2008 and 2009. Both in accounting and finance. Okay, so the purpose of this study is to attempt to understand how managerial entrenchment affects analyst following. So the focus of this study is on staggered boards or classified boards. Right, I think you understand the meaning of a staggered board. A staggered board is a board in which not all directors are elected at the same time. So usually it's about 1/3 of the directors are elected in 1 year. That's what we call a staggered board, or sometimes we call it classified board. Okay, so there have been two studies in 2005 and 2007 by Bebchuk and Cohen and Fale. So these researchers have documented that staggered boards or classified boards promote managerial entrenchment, and they also exacerbate agency costs and ultimately lower firm value. The idea is that when you have a staggered board, the incumbent managers become entrenched because they are insulated from the takeover market, so they can work inefficiently, and yet they cannot be removed because they are protected by the staggered board. And that's why staggered boards exacerbate the agency conflict, promote managerial entrenchment, and it has been documented that staggered boards are associated with lower firm value. So in this study, we hypothesized that the extent of analyst coverage is influenced by the presence of a staggered board. So basically, the number of analysts following a particular firm depends on whether or not the company has a staggered board. So the question is, why should we care so much about staggered boards? What is so interesting about staggered boards? Well, as I mentioned earlier, staggered boards have been found in prior studies to exacerbate the agency conflict. And this is because staggered boards insulate incumbent management from the takeover market. That's why they promote managerial entrenchment. Okay, there have been many studies that look at staggered boards. Bebchuk and Cohen, Fale, Jirapon and Liu, Marsulis, Wang, and Xie. That's another reason why we concentrate so much on staggered boards, because since 2006, the Institutional Shareholder Services, or the ISS, has recommended a vote against proposals for board classification. So basically, they say that a staggered board is not good for the stockholders, so they recommended that when there is a proposal to have a staggered board, stockholders should vote against it. Not only that, what they also promote is that they try to de-stagger a board. So basically, when the firm already has a staggered board, they try to remove the staggered board. So this is from the Institutional Shareholder Services, which is a very large organization and very well-known agency. So in addition, there are two more agencies or two more companies that promote, that are against staggered boards. Is the TIAA CREF, which is a very large pension fund, and also Fidelity Investments. These two organizations also don't like staggered boards, and this is why we pay so much attention to staggered boards, because they have captured so much attention both in academics and also among practitioners. Well, so the basic hypothesis of the basic idea of this study is that the extent of analyst following should depend on the presence of a staggered board in the company, right? So the question is, what should be the relationship? Well, we have two possible hypotheses. The first hypothesis is what we call the outcome hypothesis. Okay, and this is how it goes. Opportunistic managers are likely to withhold information from outsiders to conceal their effort to expropriate wealth. Okay, you can imagine that if you are a manager and you are opportunistic, you are inefficient, you cannot disclose too much information, right? Because the more information you reveal, the more likely that somebody will detect what you do, right? You may be inefficient or you may be opportunistic, and you don't want to disclose too much information. You want to keep the information environment less transparent, so you don't release much information. Now, when the company has a staggered board, then it exacerbates this problem, right? Because so as a result, firms with staggered boards experience more information asymmetry. So basically, if your company has a staggered board, then the incumbent managers are more protected, and because these incumbent managers may be opportunistic, they don't release as much information. So the information environment of your company is less transparent. Or basically, you can say there is more information asymmetry. Okay? Now, if you are a financial analyst and you are covering a firm, and the firm doesn't reveal or the firm doesn't disclose so much information, what should you do? Well, according to this hypothesis, if the firm doesn't disclose much information, then it should attract fewer analysts, right? Because imagine if you're a financial analyst and you cannot get so much information from the firm, then you are less willing to cover the firm, right? Because you cannot do your job because you don't get much information. So, according to this hypothesis, the prediction is that when the company has a staggered board, it should attract fewer analysts. Now, the second hypothesis is what we call the substitution hypothesis. Okay, it makes the same assumption. It makes the same assumption that firms with staggered boards release less information. Okay, this is the same assumption that we made earlier in the previous hypothesis. But this time, the difference is that because the company doesn't release much information, so investors turn to analysts for information about the company. So basically, if you're an investor and you cannot get so much information from the company itself, what do? You turn to financial analysts, right? Because you find the information provided by the analyst more useful, right? And that's why there is more demand for analyst coverage. In other words, you could say that analyst coverage substitutes for a transparent disclosure policy, right? Because the firm has an opaque information environment, and that's why investors demand information from financial analysts, which stimulates the demand for financial analyst coverage. So according to this hypothesis, if the company has a staggered board, then you should see more analyst coverage, which is the opposite prediction. If you look at this prediction and the prediction of the previous hypothesis, you can see that these two hypotheses predict different outcomes. Sample selection. The governance data from the Investor Responsibility Research Center, or the IRRC. I think it has the name has been changed to Risk Metrics. The data for analyst coverage are from the IBES database. We have a total of 13,338 firm year observations, and we have 1,924 unique firms from 1990 to 2004. So we have a relatively large sample spanning about 14-15 years. So this is a pretty good size sample. All right, let's take a look at the sample here. Our sample period goes from 1990 to 2004, and we have a total of 13,338 observations. About 60% of the firms in the sample have staggered boards, and you can see that the percentage of firms with staggered boards has remained pretty much stable, pretty constant over time. Let's take a look at the summary statistics, right? These are some of the statistics here. Let me highlight a couple of things. If you look at the number of analysts, you can see that on average about 9.85 or about 10. Each company has about 10 analysts covering the firm. The standard deviation is 10.55. The median is 7. And the governance index staggered boards are one component in the governance index, and you can see that on average the number of governance provisions is 9. The median is 9 as well. Now let's take a look at the comparison between companies with staggered boards and companies that don't have a staggered board. Here's a comparison. You can see that these companies differ in different ways, in many ways, right? For example, companies with staggered boards tend to be smaller, okay, and you can see some of the statistics here. But what we are interested in is the number of analysts, right? You can see that if your company has a staggered board, the average number of analysts is 9.91, and if you don't have a staggered board, the average number of analysts is 9.77, and the difference is not statistically significant. But obviously this is only a univariate comparison, so it doesn't really mean much because it doesn't control for a number of factors. Now, if you look at the regression analysis here, the model is pretty simple. The dependent variable is the number of analysts, right? And basically we have a dummy variable, and the dummy variable is equal to 1 if the company has a staggered board, and is equal to 0 if the company does not have a staggered board. And we include a number of control variables here. The first control variable is we include the other corporate governance provisions, right? We got the data from Gompers, the famous study by Gompers. Gompers et al. Has created this governance index with a total of 24 provisions, and staggered boards constitute one provision. So we control for the other provisions in the governance index. So we have the other 23 provisions included as a control variable. So basically we add up, the other provisions, and we create a separate variable equals to the number of other provisions in the company. We also include the following variables: firm size, profitability, leverage, R&D spending, advertising, capital expenditures, trading volume, standard deviation of returns, the inverse stock price, S&P 500 dummy, and NASDAQ dummy. So you can see that these control variables have been included in many previous studies. All right, let's take a look at the regression results. First of all, we start with an OLS regression, right? Model 1, this is an OLS regression. And you can see that the coefficient of the Staggered Boards dummy is positive and highly significant, indicating that if your company has a Staggered Board, then you attract more financial analysts, right? In the second model, instead of having an OLS, we use Tobit regression, because you can argue that the number of analysts is a censor variable because it cannot go below 0. So we censor the variable below 0, and you can see that the result is still the same. The coefficient here is still positive and significant. And finally, in the third model, we use a Poisson regression, because you could argue that the number of financial analysts covering a particular firm is a count variable. So we treat the number of analysts as a count variable, and we run a Poisson regression here. Again, the result is still the same. The coefficient is positive and significant. Okay, and we also have a number of control variables here. Now, in this part, we try to take care of the possible endogeneity problem, right? Because so far we assume that the direction of causality goes from having a Staggered Board to the number of analysts following, the number of financial analysts, right? Now it's possible that could be reverse causality. So the direction of causality may go from the number of analysts to the presence of a Staggered Board. So in this section, we try to address that possible problem. So what we do is we run a two-stage least squares regression. In the first stage here, we use the industry level prevalence of Staggered Boards. So basically, we look at each industry and we determine what percentage of firms in that industry have Staggered Boards, and we use that as our instrumental variable. You can see that the industry level prevalence of Staggered Boards can explain the presence of a Staggered Board in a particular company very well, right? So this is that's a positive and significant coefficient here. Now, in the second stage, we use a Tobit regression, and we predict this variable, the Staggered Boards dummy. We get the predicted value from the first stage, and then we substitute the predicted value into the regression, and again we find that the coefficient is still positive and significant. So even when we use the two-stage least squares regression, we still get a consistent result. So it doesn't look like endogeneity or reverse causality is much of a problem here. Now, there is another kind of endogeneity, which is what we call that could be endogeneity from omitted variables or unobservable characteristics, right? So basically, the presence of a Staggered Board and the number of analysts could be related to some unobservable firm characteristics. So what we do is we run a fixed effects regression here, because when you run a fixed effects regression, it does control for these time invariant unobservable characteristics, right? So we run a fixed effects regression in model 1, and we continue to find that the Staggered Boards dummy has a positive and significant coefficient. In the second model, we use the fixed effects Poisson regression, still the same result. And in the third model, we use the random effects Tobit model, same result. So we control for endogeneity in two different ways. Reverse causality, we use the two-stage least squares, and endogeneity due to unobservable characteristics, we use this fixed effects regression analysis. Now, in this table, if you remember the hypotheses, one common assumption of the hypothesis is that there is an association between Staggered Boards and information asymmetry. So in this section, we try to show that there is a relationship between the presence of a Staggered Board and the information environment of the company. So what we do is we look at the divergence of analyst recommendations, right? So you know that financial analysts issue recommendations, and if the information environment is more transparent, then there should be more agreement among the financial analysts. But when the information environment is more opaque or less transparent, then there should be less convergence or more divergence. So we use the divergence of analyst recommendations as a proxy for information asymmetry. And in this regression, in the first regression, we do find that when the company has a Staggered Board, then there is indeed more information asymmetry. Okay. In the second regression, we adjust for industry effects, and we continue to find that a Staggered Board is associated with a higher level information asymmetry. Finally, we look at the relationship between firm value, Staggered Boards, and analyst coverage. Right? Analyst coverage has been argued to benefit the company because it does impose an additional monitoring mechanism on the firm. So the argument is that it should be beneficial to the company. So we do find that analyst coverage is beneficial. In the first regression, we use Tobin's Q as the dependent variable, and we find that analyst coverage is associated with a higher value of Tobin's Q. Right. In the second regression here, we use the abnormal Tobin's Q. We adjust for industry effects. And in the third regression here, we used Tobin's Q 1 year later to reduce the possible endogeneity. And in all of these regressions, we find that analyst coverage is beneficial. Okay. Now the next step is we create this interaction variable between Staggered Boards and analyst coverage, and we find that the positive impact of analyst coverage diminishes considerably when the company has a Staggered Board. You can see the coefficient here is negative, negative, negative. So it implies that analyst coverage is beneficial. However, when the company has a Staggered Board, the benefit of analyst coverage diminishes considerably. So this is consistent with the literature that Staggered Boards may be detrimental to the company. Finally, in the last section right here, we look at credit ratings, right? And we find that analyst coverage helps improve the credit rating of the company. There's a positive coefficient here. But then when you have a Staggered Board in the company, the benefit of analyst coverage is reduced significantly here. Okay. So the conclusion here is that there is a significant association between whether or not the company has a Staggered Board and the extent of analyst following. And we find that when your company has a Staggered Board, you see more analysts covering the firm. And we argue that this is because it's consistent with the substitution hypothesis, which argues that when you have a stagger board, then opportunistic managers release less information, leading to a more opaque informational environment. As a result, investors find the report of the financial analyst more useful, and they create more demand for analyst coverage, and that's why we see that we see more analyst coverage whenever the firm has a stagger board.